please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
But right now it's time to move on to our special segment, Hunting for Value. Abhishek is joining in and he's looking at an NBFC stock today. Abhishek.
Well, Shriram Transport Finance is the stock under radar for hunting for value. The stock is down by 10% from its 52-week high that it hit on 27th April 2018. However, looking at the CV trend, that seems to be on an upside. Shriram Transport is the market leader in the organized sector of used CV financing. Let's understand why the stock fell. The stock fell on fears that an increase in load factors for commercial vehicles may impact their sales. Therefore, there are also concerns that a move towards the INDAS based off accounting may result and impact its financial on the weaker side. Under INDAS, the incremental slippages of last 3 years and the X of recovery expectations have to be written off from the net worth. For example, rupees 100 crore has been slipped in the last 3 years. The recovery expectation is 40 crore, then 60 crore has to be written off from the net worth. Key triggers for revival. Well, in FY18, if you look at the overall CV industry sales number, they clocked in at 8.6 lakh units. The last peak was at FY12 at 8.1 lakh unit. And even if you look at the growth, it is the highest ever growth in last 7 years. The quarterly, movement in terms of CV sales has registered from a negative of 9% in Q1 to about positive of 31% in Q4 FY18. So, along with that, manufacturers are now talking about expanding their production plans for meeting the next 3 to 5 year loan growth. So, based on the new CV sales which will come in and the FY12-13 numbers which will come into the new CV market, the quarterly disbursement which was at 15,000 crore plus in Q4, if you translate that to an annualized disbursement, it works out to more than 60,000 crore. Now, one key parameter is disbursement to AUM ratio. So, how much of disbursement goes into AUM after repayment? That was at 35%, which is the best in last 2 years or 8 quarters. So, if one analyzes that for FY19, then the disbursement for FY19 will be close to 60,500 crore. If you take into account the disbursement of AUM ratio of 35%, it translates into an AUM growth of 22 to 23% for FY19. With the worst of asset quality woes behind, the company expects a 70 basis point decline in their credit cost. So overall, the ROA metrics, everything remaining stagnant, a 70 basis point decline in credit cost will lead to an ROA improvement. Demand will also be driven by rural centers. 35 to 40% growth is seen in rural areas, and they have opened about 200 branches in the last 1 year in the rural center. CLSA has a sell rating on the stock with a target price of 1,210, while Morgan Stanley has an overweight rating on the stock with a target price of 2,000. They believe that they see an EPS growth of 52% CAGR over FY18 to 20. Motilal Oswal also has a buy rating on the stock with a target price of 1,950. They believe that Shriram Transport return ratios have just bottomed out, and therefore valuation in comparison to Cholamandalam Finance, if you look at the peer comparison, is of 40-45%, while Shriram Transport is trading at 4.3 price to book value FY19, Cholamandalam is trading at 4.2 times. So if you look at the valuation, it is cheaper to its next peer, that is Cholamandalam. A quick disclaimer, this is not a stock recommendation.
All right, thanks a lot for that. It's important that you pointed out the valuations as well, quite cheap compared to many of its peers. Sanjeev Bhasin of IIFL joins in. Sanjeev, Shriram Transport is a stock that has created a lot of wealth for shareholders in the past. It comes with pedigree management, great business potential, relatively good financials in the past as well. You think this is a no-brainer for investors, to buy for the long term, or are you a bit cautious for any reason?
Yeah, good morning. Well, I think, like you said, it's a no-brainer. It's a very strong brand in the south, and now that you've seen the CV cycle turn, whether it's Ashok Leyland or Tata Motor, we are seeing a lot of build-up in the momentum. The last year was on a weaker note on the back that NPS had risen, and secondly, there was the talk of merger with IDFC Bank, which brought the stock to below 1,000. Once those stocks got cut off, I think the stock has seen a very, very sharp rebound. today trades at a market cap of roughly 33,000. Now this is proxy to, you know, pure India play on the CV cycle. They have a 47% share in the heavy commercial vehicle, which is now going on the LCV side. They are one of the biggest players in the resale cycle. You have the BS4 norms coming in. You have the MSP on Andhra, in Telangana, and the other regions coming in a very strong reach. So I see no let up in this stock. And in fact, I've seen their net interest margins actually improve to 7.5 from a band of 7% in the last 2 quarters. I see no reason that the market cap should be trading at close to 50,000, which could take maybe the next year or so. As a disclosure, Sonia, I've had this stock for the last 23 years when it was used to trade at close to 30 rupees. So it has been a huge wealth creator, and I see no let up. I think a 40% upside in the next 1 year should be on the cards.
23 years. Wow, Sanjeev. That's called long-term investing. That's called just, putting something under your mattress, forgetting it because you're so convinced about it. But let me ask you one more thing, though. It is an NBFC. How do you look at its asset liability picture? Because rates have been very hard and bond yields are stubborn around 7.8%, 7.9%. So is that at all a concern for margins?
Yes, now that would be one of the negatives, that rising yields could hurt the profit. But their product mix has definitely undergone a sea change, which is why you saw net interest margins actually expand to 7.5. And if I heard the language from the competitor, Cholamandalam, they've said that even rising yields are not going to deter their margin. So Surbi, even if you have to compromise a little bit on the margin, but the volume picture looks good, which is typical of a growth economy where yields are rising because growth is expanding. I think it fits the bill. The promoter has been a par excellence person. It has got a pedigree, stock management, and I see no let up. It's one of the quality stocks. These stocks used to be trading at very, very reasonable value. This and Shriram City Union, both of which I happen to pick up, and when you over the period of discourse you realize that very, very strong management which are pro shareholder positive. So I would definitely take the rising yields with a pinch of salt.
Okay, just one more question, just continuing to play devil's advocate here. These companies that have an exposure to the CV cycle do well when the cycle is on an uptrend. A lot of people believe now that the CV cycle may have perhaps peaked. FY18 was a great year, maybe not as good for the next few years. And also there's this concern about delayed repayments by borrowers, right? Because of soaring fuel prices affecting their cash flows, etc. Would all of this restrict the upside, you think?
So Sonia, firstly, we have to be prepared that there is a very good probability of a very strong monsoon. And you see the harvest is linked more to regions in the south where that becomes a very big positive. Secondly, like I said, the BS6 norms will see an advocation of resale market picking up. And thirdly, like you pointed out, I think the short-term variables in crude may be looking very, very overstretched. The government has been very, very, categorical that they are not going to cut prices and it will be market determined. And that could be a slight overhang. But I think given the broader green shoots which we are seeing develop on manufacturing, on cement sales and so on, give us enough confidence that the next 6 months could actually be much more positive on credit expansion and, vehicle, traffic movement of goods over the next, 6 months for the economy. So we would take that, like again, I said, with a pinch of salt and use declines to accumulate this stock.
Okay. All right, Sanjeev, we'll leave it on that note. Thanks very much for joining in. That's a thumbs up on Shriram Transport Finance from IIFL. Right now, it's time to focus on the commodity cues all over again. And yes, it's the big headline from Vienna that we are all anticipating and awaiting. Over to you, Manisha.
Thank you so much for that, Surbi. Well, yes, crude oil price is totally in focus and we are trading nearly a percentage point higher in the global markets as the markets are, reacting to various statements coming in from Vienna already, as the oil ministers have been talking to media. So the expectation is that you might see some increase in the supplies, but how much, that is not clear. And that's exactly what the crude prices are reacting to on your screens. 0.5% up in the the Indian markets, but much would really depend on the statements that would start coming in from Vienna from 1 p.m. and 4:30 p.m. is when that press conference is. So further directions, of course, from that one. The strength in US dollar is something that has continued to weigh in case of the gold and silver prices. In the meanwhile, gold is trading at a 6-month lows in the global markets, and we have seen constant declines come in for Indian as well. 30,500 or thereabout now, just about holding, and silver hasn't been able to hold above that 40,000 mark for last 4 or 5 sessions now. It also is a weekly decline for many of the base metal prices. Steel, for one, is headed for the worst weekly decline in last 2 months. We have seen prices go down by 3%. Copper prices are trading very flat on your screens, but that one is also down for a second straight week. We are looking at prices holding around nearly 3.5-month lows for copper as well. That is the case across base metal prices. Zinc is trading at around nearly 8-month lows. Nickel prices, they started a week in the Shanghai market, but we have seen some buying on the lower side, and that's reflecting on the nickel prices here. Also, there are reports on how the inventories have been declining in Shanghai and LME warehouses. That has led to some support as well. But these markets also would continue to be jittery because of the US-China trade war spats. So not too long positions is what we've seen coming in for this sector too. Comtrends is what we spoke to in sense of strategies today. They have calls on all the metals. For gold prices, they're expecting a buy with 30,850 on the higher side for the day today. They are looking at crude oil prices to continue to decline. 4,200 is their target on the lower side for that one. For copper prices, though, they have a buy yet again. 460 per kg is the target for the day.
All right, thanks a lot, Manisha, for that. Let's take a short break. On the other side of the break, we will revisit that Shriram Transport hunting for value segment. In fact, the management, Umesh...
Welcome back. So the market is still holding on to a cut of about 20 points on the Nifty. It's the mid-cap space where there is a slightly greater decline at this point in time. You are seeing some stocks come under pressure. Granules is one of them, 4% down. A couple of sugar stocks on the lower side. Ajanta Pharma. Some of these mid-cap pharma names have done very well this week, but right now there's some profit-taking that is going on. Well, as promised, let's get you a slice of that very special conversation that Shireen Bhan had with market veteran and investor Rakesh Jhunjhunwala. Here, Shireen and Rakesh discuss a lot of sectors and what Rakesh likes at the moment.
So let's talk about the sectors that look promising to you today. And let me start by asking you about what has been a consistent bet for you, and that is pharma. You know, we've seen a revival as far as the pharma index is concerned. It's up, what, about 15%, but still off its lows, off its highs. Do you believe that the worst is behind us when it comes to pharma? Does this sector now inspire confidence?
I'm pretty sure the worst is behind us. See, the problem was the US generic competition. The fact that there were all kind of threats that the government imposed price control in India, and 3 was the currency, right? If you see 17, 18 over 16, 17, everybody's realization in foreign currency was 4-5% lower than what was in the previous year. This year it will be 5% higher than what it was last year. I think the generic competition in America is leveling off now. And see, the Indian pharma branded generic industry, right, is a FMCG. And whatever government may say, unless they make a mechanism by which they inspect the quality of the plants that make the medicines, how can you generalize it? Will you take a medicine from a plant which you don't know whether it has followed quality or not? And you know, that's growing at 15% a year. And there the EBITDA margins are 20-25%. The capital employed is, the ROEs are 40%, 60%. So I think the pharma industry's worst is very much behind it. And now I think the Indian pharma industry is entering an unknown, risky but exciting phase, where companies like Sun, Lupin and others are going into specialty generics, right? Even if one of the medicines succeeds, it could be a game changer.
So does this inspire fresh confidence, renewed confidence in you as far as the pharma sector is concerned?
I was always an investor, and I am confident they will do it.
Would you look at adding more pharma to your portfolio?
That I don't know what I will be doing.
Okay, let me talk to you about banks. And you know, you've been betting on the likes of Karur Vysya Bank, Federal Bank. We understand perhaps even ICICI Bank more recently. What's the story as far as banks are concerned? How do you see the private sector banks versus the public sector banks? Public sector banks losing about 5.5% market share in the last 10 quarters. What's the bet?
I have a very simple theory. That See, most of the problem of the, first of all, India has had subpar credit growth in the last 2-3 years. But if India is to grow 12% nominal, this is a 7 to 8% growth, 4 to 5% inflation. There is nowhere in the world that credit growth can be less than 1.25 to 1.5 times nominal GDP growth, right? Now let us suppose 1.25 times nominal GDP. So you're going to have 15% credit growth. 70% of the market's growth is only going to be 5%, which is the public sector, right? That means the balance 30 will have a growth of 10%. That is 30% of the present base. So the opportunity to grow is unbelievable, right? You cannot create the banks tomorrow. Then you come to the banks which are in trouble. Most of the bad debts were related to corporate lending prior to 2013. I mean, you play an innings 1 year, 2 years, 3 years, 4 years, 5 years, 6 years, somewhere it will come to an end, right? Second thing is, if you look at the pre-provisioning profits, once the provisioning normalizes, the profits will just go through the roof. So the return on assets will go up, the ROEs will go up, consequently the valuations will go up. So not only will we benefit by enhanced earnings, we will also be benefit by enhanced valuations. So I think banking today, especially good banks who have legacy problems, right, are very attractive investments, and I have invested.
Okay.
I am an interested party.
You're an interested party. I'm glad that that you put out that disclaimer amply. But you know, there were a lot of people who were concerned, perhaps rightly or wrongly, I don't know, when you were on the Federal Bank conference call, and you seem to have signed off by saying "God bless," and people were interpreting that to mean that you know, you were signing off altogether.
Not at all. Not at all. I don't know why people are interpreting all that. I have a habit, I always say God bless, right? You know, and I said, you know, they had some write-offs in the fourth quarter. So I was saying God bless that we don't have these write-offs in the future quarters. And I personally feel the provisioning of Federal Bank has more or less peaked. So well provided for bank.
So this would this be a sector then that you would, again, like pharma, look at with renewed confidence?
Absolutely. I'm extremely bullish on banks, especially those who are in trouble.
Including ICICI Bank?
Absolutely. ICICI Bank carries a lot of the characteristics of HDFC Bank. Their CASAs, their retail. It's the legacy which is the problem. That legacy, believe me, is going to get over in 18-19. Don't expect anything in 18-19, whatever these chairmen and directors and analysts tell you. 18-19 is also a year of provisions. But there will be growth in profitability. And 19-20 will be an absolute clean year economy. When 9 out of 10 banks will come back to normalized provisions in the private sector. I don't know about the public sector.
And does this enthusiasm and confidence also then extrapolate itself to the NBFCs, which have already seen a significant run-up as far as valuation?
Yeah, so they are now, they're more than well valued in my opinion.
So that's not exciting you?
That's not so exciting.
So you don't really see any enhanced value or opportunity there?
See, there the valuations are, there are two ways, Shriram, you can gain in an investment. One is with earnings growth, but near multiple is earnings growth with valuation growth. So I think in NBFCs you may gain with earnings growth, but there's not going to be valuation growth. In all these banks which are in trouble, there's going to be both. Earnings will grow, and don't expect in 18-19, 19-20, 20-20.
Because you believe that the provisioning process will continue at least?
No, 18-19 will be over, it will be over. And then 19-20 will be normalized provisions. And there'll be good growth. And why do you give HDFC Bank today 5 times book? Because of his ROE and his growth. So ROE and ROA of other banks will go up, and slowly growth will also come. So I'm not saying there'll be 5 times book, but surely I think good banks will be 2.5, 3 times book.
Let me then talk to you about another bet that you seem to be making, and that has to do with cases that are either in the NCLT or moving towards the NCLT. And you did say in the past that the NCLT is a wonderful thing, that the process itself needs to be refined. You know, where do you see that entire process today, and what excites you about the assets that are already in the NCLT and those that are likely to be headed that way?
What excites me most about NCLT is that it will improve credit discipline and integrity in this country. Because every entrepreneur will now be afraid that, you know, if somebody owes me 1 crore, a company, and I go to the NCLT, he's paying. But otherwise, even a person who owes 50 lakhs. So this will improve credit discipline in the country. Let us say there's a large company. It doesn't pay its suppliers right in time. Earlier, the banks used to accommodate the supplier. Now the banks won't accommodate the supplier. So what a supplier will tell the large company that either you pay me or I close down. So then he will pay in time. So this is going to improve the integrity and the credit discipline of the entire country. People are underestimating what the effect of the NCLT is going to be. People are, you know, project lagao, project is actual 2,000 crores, make it 2,700 crores, only put 600 crores of equity, so there is 1,000% return on your capital. All that's going to stop.
Okay, pearls of wisdom coming in from the big bull himself. But let's move on now. Capacity Infra is a stock on our radar. On the exchanges today, they informed that they've received a letter of acceptance from MHADA for redevelopment of the BDD Chawls project. Remember, it's a very ambitious project that was launched by the Maharashtra Chief Minister Devendra Fadnavis in 2017. And several developers were eyeing this project. Now they've won this for a contract value of 11,744 crores. And it will be executed through an SPV in which Capacity Infra will have about 37% share worth. Tushar Srivastav, the head business development of Capacity Infra, joins us now to talk about that. Tushar, thanks so much for joining us. Congratulations, first of all. This is, of course, a very important project and a lot of people were eyeing this. But tell us a little bit about how long do you think the completion of this project could take? How many phases will it happen in? And what are we looking at in terms of, the next couple of years itself?
See, as you rightly said, this is one of the very ambitious projects in housing sector, which the government of Maharashtra has launched. And this is close to around 2.3 crore square foot construction that is going to be undertaken in Worli. Now, this is not a conventional housing project because it is basically a redevelopment project. As you know, the BDD Chawls have been more than 140 years in existence. So it is basically going to be rehabilitating the people, demolishing the existing structures, giving them new buildings, and then, taking them to the new buildings. So this project is spread over around 8 years, the pure construction, and then based on and with reference to the defect liability period, additional 5 years have been. So the total project, the tenure is around 13 years.
Tushar, so your share stands at about 4,357 crores.
Yes.
What is the revenue recognition process that you'll follow for a project like this? How do revenues start flowing in?
See, at this moment, it's slightly early to comment on the revenue recognition because, as I told you, this is not a conventional real estate project because I'm not getting a open ground to go ahead and start my construction. So it is going to be it's basically a very sensitive project, where we'll have to go ahead and phase-wise. We'll have to first make the transit camps, shift the existing people, demolish their buildings. So at this stage, it's very difficult for me to comment as to how the revenue recognition is going to work on this. But definitely, it's, I think, in all practical respects, based on the phasing which has been given to us by the MHADA, I think in the third or fourth year, we'll start, recognizing our revenues.
So the recognition could be, only from year 3 or 4 onwards. I mean, that's how a project of this nature works.
Yes.
Okay.
See, because we are working in Worli, and as you know, for a contractor to work, there is no much of a space available. So we'll have to, and this is basically from a contractor's perspective, is going to be a logistical challenging project. So we'll have to plan it very meticulously, and that's how we will be phasing it out with help of the government and the local authorities and taking it forward.
Oh yes, we work in Worli as well. BDD Chawls are very close to where we work, so we know all the kind of challenges that you would face. But just a quick last question from my end. Since this is your first public sector project, any more that you plan to take up, any more JVs that you would be bidding for? And also, what are the key challenges from a regulatory front that you would face on this project?
This is, our first public sector project, and we are actually bidding very aggressively in other public sector projects as well. But as far as capacity is concerned, we'll only be focusing on the housing sector. So I'm not going to enter into any infra works with any joint venture. Our core is building, and we'll stick to the building projects only. So a lot of projects are coming up, a lot of hospital redevelopments are coming up, a lot of secretariat buildings are coming up, Pradhan Mantri Awas Yojana is coming up. So we are looking forward to target these projects in the future.
Okay, Tushar, we'll leave it on that note. Thanks for joining in. That's a big project for Capacity, but of course, these are laborious task, not that easy. Revenue recognition is not happening immediately, which is why you've seen the stocks sell off. We'll take a break and come back and get you that conversation going with Shriram Transport Finance.
Hi, welcome back. Well, let's do one thing. Let's get you a CNBC TV exclusive now. Our colleague Mangalam caught up with the recently appointed CEO of VIP Industries, Sudeep Ghosh, to know more about the company's strategy with respect to individual brands like Carlton, Aristocrat and Sky Bags. Here's what he had to say.
As an organization, we want the segments, like he spoke, which is above 6,000, to become very, very strong. And we would like to at least triple the revenue that we get from Carlton in our fold. It's a product that we are very confident. We took about 2.5 years to get the proposition right, and we have launched a product now which we are very proud of, and we say
it's being received well.
It's been received very well. We are actually run out of stocks.
All right, triple your revenues from Carlton in the next 3 years.
Yes, definitely.
All right, all right. Let's talk about the sub 6,000 Aristocrats and Alphas. That would account for what, 8 to 10% of your revenues, and that would triple as well?
Again, as I said, I'm not going to give you numbers, but
more than that, less than that?
That has a far more or far bigger potential to grow.
Okay.
I think currently that the growth of those brands are in excess of 40%. That's big for us. The bases are big, and the kind of plans that we have, we think that is going to be the next big thing happening to our organization. We just need to ensure that we keep the costs down.
Skybags, you've been very instrumental. I am told that you were the brain behind Skybags, and you decided the whole backpack range and whatever it is your brainchild. So let's talk about that. That contributes what, about a third to your total revenues?
Yes.
Right? And going forward, what is the opportunity? Will this be the majority contributor to your revenue, say, in the next 5 years?
So when I took over, we were mainly a luggage brand, almost a luggage brand. And luggage, as you see, consumers, when does a consumer buy your first luggage? The first luggage consumer buys when the person is around 28, 29, 30 maybe. Not when the person gets the job, because when you get the first job, you still take your parents' luggage and travel.
Yeah.
So the consumer is getting into our business at a far later stage of life, and that is the time when he's already exposed to multiple brands, multiple multinational brands available. So we had to get the consumers at an earlier stage. Now, backpack was the very, very important category. It was like, when the moment we started getting backpacks in, we brought down the average consumer age from, say, 45 down straight to 20.